3, 2, 1. Welcome to the show.
All right, then. I thought I just wrecked the table. Apparently not.
Yeah, we had the music playing just for a second longer because Jerry thought he kicked out one of the cameras.
All right, I guess we're good. Excellent.
I can still see all of them.
There
you are.
We'll call it an April Fool's joke. How about that?
That's tomorrow.
Yeah, I know. This is Friday as we're recording, and tomorrow will be April Fool's. So much stuff going on this week, I swear. I was just talking to this woman in the coffee break room there about April Fool's, and I'm like, there's so much craziness going on in the world. I think it'd be hard to do an April Fool's thing this year. Everybody would either believe it or,
be like,
nobody would believe it.
Of course that's what just happened. Yeah, monkeys are flying.
Yeah,
they are.
It's insanity. So 8:30 this morning, PCE comes out. Personal consumption expenditure, PCE. It's one of the Fed's.
That's one of those that they don't stop NBC News for.
Well, they stopped Bloomberg, but not NBC. Yeah.
Bloomberg, yeah, of course.
So it was 0.3. It was up 0.3 year over year, which the street expected 0.4. So it was lower than expected. So that means inflation is not rising as fast, which means the Fed is going to supposedly interpret that as.
Of course, that one indicator is going to drive all these things.
Yeah. But anyway, that's what's driving the market higher, as we speak.
Today.
Yeah. Along
Friday.
With Friday, yeah. I mean, it's a good thing because what we have been seeing mostly throughout this bear market is the market tends to be up in the beginning of the week and then trails off and tends to collapse at the end, especially on Fridays. And so a strong day on Friday, that's always a good thing.
Yeah.
So it was a good week,
especially when we're in the market.
Yeah, no, it's that's one of the things we're gonna talk about that, but it's one of the hardest things about TSP because it's a long-term investing vehicle, and we're going to talk about a couple different ways of kind of how to come to that, but you have to pick a day, you have to get into the stock funds and out of the stock funds on a day before noon, and you're going to get that day's closing price. So
yeah, in the TSP.
In TSP.
I mean, we have that's the thing that so many people, when we're having chats on social media, they'll be like, oh, this, that, and the other thing. And I'm like, you say all that, but you leave out the fact that we got to make the trade by noon, and we can only do this twice a month. So, we can't just willy-nilly get back in or get out. You have to think about, okay, can I get a long trend there? It doesn't have to be forever, but I want to catch an upwind that's long enough for me to be able to get back out, or the reverse, right?
Yeah.
The trend's got to be long enough, longer than a day or 3 days, because people are like, oh, the market was up for 3 days last week. Why weren't you in? And I'm like,
right.
I went back out. You're missing the other piece.
Yeah. That's what this whole slide deck is going to be about, to be honest. It's your mindset, right? If you're a buy and hold person, then none of this matters. You're continuously investing in the stock funds, and you're going to go along for the ride.
Why are you even watching?
Right, that's fine. If you're actively managing, right, there are basically 3 ways to think about what you're doing, and you let me just flip to the first slide here. So, what game are you playing? Okay. You can either basically have the mentality of a day trader, the mentality of a swing trader, or the mentality of a trend trader. I'm going to talk about all 3 of them, but really as we're talking about it, and it's, I'm going to do from Investopedia like I always do and what the definitions are, but more so than using it as a methodology, the idea when I was putting this together is to think about it in terms of how do you come to TSP. So and we see it all the time in social media.
What you come from,
right? So if you're like, oh, I should have, I knew I should have sold yesterday because I could have made back the 5,000 that I lost last week. You are thinking like a day trader. Okay, it's not in your best interest to think like a day trader in terms of TSP.
It's just impossible to do.
I mean, I'm not trying to bash anybody's, and it's very hard because if you focus on your account balance and you watch the numbers go up and down on a daily basis, it's about impossible not to have your come from be like a day trader.
The shortest amount of time that we can even remotely work with in this in the TSP is 1 week.
Yeah.
That's still, you're still kind of really squeezing it down, right? I mean, I would say, correct me if I'm wrong. I mean, we're kind of in the weekly game, right? But that's because we make it our full-time job.
Right.
If it wasn't our full-time job and you didn't have us helping you and you were doing this on your own, weekly it takes some work. Not a lot of work.
Yep.
Not a huge amount, right? We always talk about how if you get your charts out on Saturday,
yep,
and look through them for a few minutes, put your lines in the sand, and go back to work, go back to business. Yep. You can make a decision whenever that happens throughout the week without even looking at anything, and you can play that game very well. Now, let's just say that's still a little too much for me. Well, then even playing the game monthly, if you spread that across 30 years, you're going to do extremely well.
Yeah, for sure. Yep. Yeah. And it doesn't take much. We've done it on a whole bunch of shows. You put in either one trend line or one moving average line, and as price oscillates, above and below that line, if you're looking at a 30-year monthly chart, there are very few times when price gets below that 200-month moving average line. So if you're willing, but now when you look at it that way, you're going to take 10, 15, 20%, call them drawdowns. You can't call it losses because they're drawdowns. But if you're in a long-term game like that, the market goes up and down. And so
you're saying if you do take the kind of monthly or 3-month kind of approach, or even longer, if you're like pretty much just passive buy and hold, you're going to take those big drawdowns. And that's what I would say in our methodology are, right? That's our rule number one.
Yeah, we're trying to avoid those.
We don't want to lose that money. We don't want to have that drawdown. Right. It's not so much as a loss to us as our account balance is going to go down during that trend change. And so we want to just go over here and park in G, and if you don't believe in that, move along, but park it in G.
Right.
We're still going to get a little bit, but we're going to hold our money.
Right.
And then as the trend changes again, we're going to go back into the market and try to get some of those gains.
Right. We did a video on that sort of a while ago, the difference between a drawdown and a loss.
Yeah. Fallacy of a paper loss.
Fallacy of a paper loss.
Yeah, it's at the top of if you're in our public Facebook group, top of the featured items or something, there's a video up there Jerry did on fallacy of a paper loss.
Yeah. You're not making gains or losses, and a lot of people think I don't realize my losses in the C fund unless I move to the G fund. If you have $1 million in your account and it's all in the G fund, you have $1 million in your account. If it's all in the C fund, you have $1 million in your account.
That's not going to change based on what you reallocate. Let's say nothing changes the day that you reallocate, because of course if it does, you might lose a little or gain a little. Right. But let's say nothing changes and you move one day, you decide I'm just going to move it all to G because I'm going on vacation for 2 weeks and I don't want to think about this stuff. Yep. And so you do that. And I tell people all the time, like, if you're going to go on vacation for 2 weeks and have park that sucker in G.
Sure.
And go have fun. And you don't even have to look at stuff and worry about stuff. So you park it. But to your point, if there's $1 million that day in your account and you move it over here, there's still $1 million.
Yep.
You didn't lock any losses in. You didn't do anything. All you did was reallocate it from one bucket to another bucket. Right?
Yep, 100%. So the losses come, and it's not when you withdraw money from TSP, that's when your account balance goes down. That's when you're spending it, so it's not a loss.
You're depleting your bucket.
You're depleting your bucket, yeah. I mean, and that's why we are building the bucket in the first place, so that when you retire, you can deplete it.
Yeah.
Right? That's the point.
And when people decide to say, I'll just throw this in there, because it's in one of those videos that you did, people to say that I'm going to buy these cheap, on the way down, you're buying a depreciating asset. Yep. You're buying something that was worth X and now is going to be worth less. And how that's going to be reflected is in your account balance. It's not the same as in a brokerage account. This is a retirement account. Yep. All you need to focus on is your account balance.
Yeah,
and if you're buying it and it's going down, you're not helping yourself. No. Doesn't work that way. No. All right. Did we talk enough about it?
Yeah, I think.
Let's jump in there. I
like
the topics of this week.
Yeah. So again, the idea isn't is just to sort of self-reflect about how you mentally come to this game. Okay, so the first way is day trading, and a lot of people look at it this way. So a day trader is a type of trader who executes a relatively large volume of short and long trades to capitalize on intraday price action. Obviously, we can't do that in TSP, right? We use SPX or SPY maybe on the charts and candlesticks so that we can talk about it. But TSP is like a mutual fund. You get one price that day. That's it. It's that day's closing price. So, we can use indexes that do trade intraday to give us an idea of what's the momentum and things within the day and all that. But in terms of TSP, you get one price that day. So there is no day trading. In reality, there's no day trading in TSP. But the mentality can certainly be there. So I don't want to spend too much time on here because you can't do it. So the big takeaway is day traders are traders that execute intraday strategies to profit off relatively short-lived price changes of a given asset. They do mostly, a variety of techniques. It's mostly technical analysis, characterized by technical analysis with a high degree of self-discipline and objectivity. Day trading can be lucrative undertaking, but also comes with a high degree of risk and uncertainty. And that's when you can trade minute to minute. For us, having to have your trade in by noon to get that day's closing price, but thinking like a day trader is just something that I'm not saying you can't do it. Obviously, a lot of people do it, but it's not helpful. All right, so I'm not even going to worry about the day trading techniques.
I would say that sort of trading is not sustainable. It's not efficient, right? And it's over the long term. It's not. Normally, what we've seen is it's not any more, performance driven, profitable, high returns as what we're going to show you. If you what's next, right?
I mean, literally, you can't do it. So to think that way is really self-destructive.
Right, and the fact that you can't do it but you still try is the problem, right?
Yeah, it's not that you can't try; you literally can't do it. So, but the mentality is there. It's when you say, "Oh, I should have done this yesterday because then I could have locked in my gains that I lost last week." That's kind of I see that a lot, and it is a day trading mentality that you cannot physically do in TSP. Mm-hmm. You just can't do it.
Yeah, and I think it also puts you in a position of emotional decision making, right? Which is another thing that we talk about a lot. Yeah. Whereas you can't use emotion to make these financial decisions. You have to use facts and data. Yep. You have to use analysis, and then make your decision. But having emotion and fear involved is just going to make you, first of all, it's going to make you anxious. Yeah, it's going to give you anxiety, and then there's no reason for it.
Yeah, no, it doesn't do you any good for sure. Okay, so not even going to worry about the techniques to it. Here's the biggest con. I mean, some assets are off limits, like mutual funds, right? So forget about TSP. Mutual funds are the same kind of thing, except you can buy and sell them. You only get one closing price on a mutual fund, but you can watch it throughout the day, and or a proxy for it, and buy or sell that thing at the very end of the day. It's not, you don't have the noon rule in mutual funds, right? But even that they're saying are off limits because you can't trade it intraday. So this, and again, it's all about the mentality. That's all I'm trying to get across here. The day trading mentality does not work in TSP, and if you can wean yourself from that mentality, it would help a lot. Okay, and so the other two we're going to talk about, in contrast to day trading, is swing trading and trend trading, right? So swing traders try to anticipate the peaks and troughs of a stock or a fund's price movement over a longer time frame, right? Weeks or months. Okay. With the right strategy, swing traders can earn higher profits than intraday traders, but they have to spend more time looking for suitable stocks. In our case, we don't have to look for suitable stocks. We only have 3, plus the F fund, so 4. And then the next one, longer, is trend traders, which is similar to swing trading. And we actually kind of do a combination of both. But So similar to swing trading, trend trading examines a stock's momentum and moving averages to determine whether a stock is likely to move higher or lower. That should sound really familiar. Then they buy stocks with a strong upside or short those that are likely to go lower, right? Trend traders are likely to look for chart patterns or technical indicators in their forecasts. So obviously, generally speaking, we are trend traders. And it works the best when we have a trend. We had a trend from January to October. And you could argue that we have a trend now from October 22 to where we are now. It's generally trending up. The question is this up move that we've had in the context of a longer downtrend that started in January 22? So we're going to kind of show an example of that example actually at the end. All right, so that's trend, what was that? Day trading. Swing trading. Okay, so swing trading. Let me throw this out here for now because Conan bought this book. Kind of cool. See that?
See if you can read it. Dancing with the Analysts.
Dancing with the Analysts. Yeah. So I haven't read it. I think I'm going to read it this weekend because I flipped through a couple pages and it kind of.
It's a novel, which is a novel idea for a financial services book. So what they did is they kind of took some principles that they want to get across to people, and they made it into a story, right? A novel. So it's a little easier to read. I'm actually doing the audiobook, and I like it because I always judge an audiobook by who reads it and how they read it, and this one has kind of got me. And so it's a great little story, and it's we haven't really gotten to the part about what what actual investing principles they're going to try to get across. So we'll come back to that probably in another show. But a friend of mine, she has gotten into the financial services industry, and the companies that she's working with, they promote this book a lot, and so that's how I came across it. And so I thought, we'll see what they're. We'll give our book review afterwards.
Yeah, for sure.
Maybe we should start doing those in some of the podcasts. Let's do a book review. Except most books that you read about in the financial services industry.
They're this thick. And
I just got another one from Amazon this morning, and I haven't even opened it, so I don't remember which one it is, because I usually just add to the library all the time. Yeah. And I'm like, once I can get to that one, I'll read through it, because I like to see other people's take on things, right? First of all, a lot of these really good books were written in like the 70s and 80s. Mm-hmm. And so they were written, and if they're still relevant now, people are still buying it. Yep. That means something in there is pretty consistent. Yep. It may be, and normally the people that have wrote those books are still managing billion-dollar funds. Yep. So I'm like, okay, I'm not going to pretend like I know more than this person. Right. Let me see what they're talking about. And there's usually a few nuggets in there that you can take. Like, we're probably not capable of doing what a certain person does in the TSP, right? But you can say to yourself, how can I apply those principles to what we do, right? And I think that's a way that you've gotten to where you're at over the years. And that's kind of what got me on this kick of getting all these different books is, I'm sure you didn't start out, I don't know what you started out with, but it probably wasn't the Fibonacci.
No.
Right? You probably just started, I know you started off with old school pen and paper.
Yeah.
But, you didn't start with Elliott Wave and Fibonacci. What you did is you got there after you understood some other fundamentals, and you were like, ooh, this speaks to me, this works for me, and I can apply it to the TSP. And so, anyway.
So the reason I'm bringing up this book, okay, because the back cover kind of grabbed me. So here's here's the idea of the book, right? The surprise gift left by his deceased father was a test, a very clever test. It left him $1 million, a challenge, and a desperate race against time. So if he could make 15% a year on that $1 million for 3 years, he would receive another $5 million. Okay? Or he could just as easily lose it all by trying, right?
And he gets to keep the $1 million plus the gains, so it's still coming out to like $6+ million.
Right. So that's the thing of the book. So spend it on his life dream, spend the $1 million on his dream life, or risk it and go for the $5 million. Okay, so that's what the book is about. And the reason I'm bringing it up here is because the premise of that book is swing trading. That's what that is. If you want to you have a certain chunk of money, and you have a goal down the road, and I'm gonna get into let's say the C fund when it looks like it's a good time to get in for whatever your analytical reason is, And then you're going to say, okay, when it gets to a certain point, either a certain percentage or if it gets to here and I see these things in the chart or whatever, but your goal is to make gains and then sell it. And then you get that money on the side, and now you're waiting for the chart patterns to set up again so that your odds go up when you get in that time. So you're just trying to make a chunk, put it on the side, take it over here, make a chunk, and so you're growing your snowball that way, as opposed to trend trading, where you're generally leaving it in there for a longer time. We're going to get to that too. But the book is basically, how do I make $5 million out of $1 million in 3 years? And you don't do that by trend trading because you don't have time to let it grow. The market always goes up, and we're going to let it grow.
I mean, really what he's looking to do is get 15% a year.
15% a year for 3 years.
Then they give him the $5 million, but the 15%, I mean, the reason that caught me is because if anybody could find a methodology that works for them, that gets you anywhere near 15% a year
consistently,
you should stick with that.
Oh yeah.
Right? Because, that's incredible. I would even go as far as to say 10%. Like if, a lot of people nowadays, because they've only been paying attention, for the last 15 years or whatever, right? This huge stock market boom that we've been going through, and some people have made 20+% and all this stuff, and I'm like, yeah, but that's not going to happen forever. And so they poo-poo when you say, like, I'd be happy with 10%. Like, if I knew I could get that year in, year out for the rest of my life, yeah, I'm good for it. If I could buy a CD for 10% for 10 years, well, then my money's locked up. So that's a bad example. But the point is, if you can find a methodology that works for you, that gets you anywhere near that, let's go, especially one that doesn't require, 8 hours a day of your life. Right?
Yeah. Yeah. It's, again, it goes to the mentality, right? So the mentality here in that book is I need to make, over the next 3 years, I need to make 15% on my money every year. Mm-hmm. Now, that if that was the challenge in 2022, it would have been very difficult, right? Because there weren't many things that were going up, but there were plenty of things that you could have done 15%. If your sole focus was on, I want to make 15%, you're not looking at the C fund and the S fund and the I fund. You're not looking at energy is the only thing last year.
You're not looking at indexes.
No.
Right. And I think that is to the detriment of a lot of traders, right? People who consider themselves day traders or traders for a living, like, independent traders, right? That they're doing this in their basement in front of the computers, whatever. And there's plenty of guys doing it, making a lot of money, because they found their sectors, their pieces of the market that they understand, and they're doing it, right? And so that's that's the principle, right? Is like, but again, those guys are doing this every day for 8 hours. That's their full-time job, right? And so you should be good at it. If you're not, you go back to work. Right? If you're not getting those gains.
There are all kinds of systems out there that say, work for an hour a day, and there's one that I was looking at that trades E-mini futures. So the very beginning of the day, from 6 a.m. to basically when the market opens at 9:30, you can trade that. And if you have certain patterns set up, and you buy it, then you sell it, it's swing trading. It's day trading using a swing trading thing. And then that's it. For the day, you're done.
Right. You picked that window of time to focus all your efforts in, because you know that there's a big enough movement in there that if you can catch it, you're going to make a good return and be done for the day. And a lot of people wouldn't be disciplined enough to do that, right? Because that's when I see someone that actually is doing that consistently and good at it, it's usually because they're massively disciplined. And they don't listen to the noise. They don't listen to anything other than the fact that this speaks to me. I know how to do it, and it's repeatable, and I'm getting X%. And they're also not trying to get 100% returns or all these crazy. They're like, no. I know I'm only going to get some. I think I know the guy you're talking about, but some days it might be a 3% return. Some days it might be a 50% return. Some days it might be a 10% loss. And of course it averages out. But he's not fazed by that. He's not waking up and going, I got a 10% loss. Nope. It's just following the pattern, doing the thing. And over time, he's getting a damn good return.
Yep.
Right.
Working very. Once he has it all drilled down and all set up and everything, he's only working a couple hours a day. Yeah.
I would also say it probably took him 10,000 hours to figure that out.
100%.
So
I was trying to sell it as a
he
methodology.
He wasn't working 1 hour a day to begin with.
No, definitely not. All right. So swing trading. Technique used generally associated with technical analysis, in which the trader seeks to profit from short-term price swings. Swing trading involves taking trades that last a couple days up to several months in order to profit from an anticipated price move. So, swing trading exposes the trader to overnight and weekend risk, which day trading does not do, right? Because you're out by the end of the day. So in swing trading, you are taking that overnight and weekend risk, which we do in TSP, where price gap is supposed to check the market. It's 11 a.m. Supposed to be checking the market. All right. Swing trading exposes the trader to overnight, and weekend risk. Swing traders can take profits utilizing an established risk-reward ratio based on a stop loss and profit target, or they can take profits or losses based on technical indicators or price action movements. So that should all sound very familiar because we do all those things and we talk about it all the time on the show and certainly in the newsletter. Advantages and disadvantages, I'm not even going to worry about that. Pros and cons. Swing trading requires less time than day trading to do. Maximizes short-term profit, potentially by capturing the bulk of market swings, which is the point of what we're trying to do. Swing traders can rely exclusively on technical analysis, simplifying the trading process. It certainly helps you block out the noise and all that. Those are the pros. On the con side, swing trade positions are subject to overnight and weekend market risk, for sure. That can be a problem. Abrupt market reversals can result in substantial losses. Absolutely. And also abrupt upsides can result on significant gains. Swing traders often miss longer-term trends in favor of short-term market movements. That's a big thing that people talk about as a downside of what we do, because there are years when the general trend is up, but it's very volatile. And if you're swing trading, you tend to get kind of kicked out in there. So yeah, you can definitely, you're going to take little losses along the way, whereas if you had just buy and held, you would have gotten the whole thing. And so you can't, so you have to, again, the beginning of this was, what game are you playing? You can't say, oh, I should have been a buy and hold last year, and this year I should be a swing trader. It doesn't, you have to get good at, you have to know the game you're playing and get good at it, or go find another game to play, right? It's all part of the TSP universe, but there's a whole bunch of ways to do it.
You have to find the one that works for you.
Yeah.
And if you don't want to do any work at all, then you have to be a passive investor, and that's really the buy and hold.
Yeah.
And the worst version of that, and we just ran across this, for the past few weeks when people came to us asking us how to kind of apply our methodology to a 401k. And what really sucks about 401ks, as we've experienced ourselves, because we opened up a 401k for our company, so that we can do matching and all the same things, right? And so the problem is that depending on who you choose as your provider for the 401k, they have this already set up, combination of funds. Yep. And there are some wacky ones out there that literally take us 20 minutes to figure out what it is and what is it useful? What is in there? What is it talking about? And so if it takes us that long, how long does it take the average person who has absolutely no idea what they're doing? Yeah. Right. And so the idea of trying to figure out, what am I good at? What can I do? Like if you're in a 401k, I think it's worse than the TSP, because at least in the TSP, we have, this is not going to change, right? We've got our funds. We know what they're large indexes. They're easy to figure out. But in a 401k, it can be maddening. But what I was getting at was that the worst part that I've seen is not necessarily being buy and hold in like the C fund, but like let's just say you chose one of those wacky value corporate trust bond blah blah. There's some weird names for these things, right? And, you slap Vanguard in front of it and it's like, oh, sounds good. And, not to bang on Vanguard, they're just providing the products people are asking for. But let's say you choose one of those and buy and hold. You have absolutely no idea what it's doing. And all you know is just like, I'm not making any money, or, it's madness, right, for them.
Yeah, I mean, they're giving you a product that's a mixture of a whole bunch of things. So if you're buying like a balanced fund, it's something like a 60-40 portfolio.
There's a lot of those, and you don't really recognize it again unless you kind of dig under the surface and go, oh, I see what they did. They're taking basically 60-40 split buying stocks, and then they're also making the 60% some sort of benchmark index.
Right. I
mean,
mid
cap, small cap, whatever.
It's really not that complicated in theory, basically, right? You want to build a fund that is going to give the people that buy that fund the best results with the least amount of volatility. So the best results with the least volatility is zero. Like that's why the G fund is so attractive, because the risk of loss is zero. Nobody else has that, right? So if the risk of loss is zero, then you have to overcome that zero risk by...
The reason it's risk of loss is zero because it's written in the law.
Because it's law. Zero by law.
Yeah.
I mean...
There are a few out there, I think, that are like choices we talked about in 401k that haven't had, negative losses, but that wasn't by law. It was by... the way the market worked out.
Well, so what they do is they buy very low volatility things. What does low volatility do? Gives you very low returns.
Right.
So if you buy these funds that are balanced, that have low volatility, you're not making much. And under the best conditions, you're not making much. You're not losing much, but you're not making much.
Right.
So yeah, it's rough if you're out there in a regular 401k. It's hard to figure out what you got and what you don't. All right, so an example of swing trading, right? I don't even know what company this is. Apple. All right. So here's an example, right? We got a cup and handle chart pattern. Okay, we had a high here. We got a cup. We got a handle. We broke out of the cup and handle here. That's a great chart setup, right? So if you're a swing trader, when price breaks out of that pattern, you would buy it. And you might say, okay, if it goes up 20%, I'm going to sell it.
And you wouldn't see everything to the right of that.
Right, correct.
Right? You're just going to see the cup and handle. So you'd want to make sure, if you could put your hand over the rest of that,
that's all you're
say that's all you're seeing. That's what Jerry's saying. It's like, hey, that's a buy signal to go, okay, because it's coming out of the cup and handle.
Right. And so if you're...
It's coming out of the handle.
Right. So as soon as it gets above the top of the cup on the left side, it's the buy trigger. So like right there, right? And then your stop loss is below the bottom of the handle, right? So this is your risk from where it broke out to the stop loss. That's your risk, and you're expecting, for whatever reasons you think that the market's going to go higher from there, at a percentage that's high enough that takes into account that risk, right? So it gets up to, say, 20%. Say that's your goal. If it goes up 20%, I'm going to sell it. That's one way to do it. The way they're doing it in this example is it comes up to they're using technical analysis, right? So you get this gain, and then it starts to consolidate. And it creates this, in this case, the head and shoulders, but you can see the support level right there. And then once
it's pretty clear.
Yeah. Once it breaks below that support level, you say, okay, I'm out. Like that's a technical analysis way of doing swing trading, as opposed to saying if it goes up 20%, I'm out. You can use all kinds of different ways to do it, but and that should look pretty similar. It's pretty similar to what we generally do in TSP, at least our methodology. And then the last one is trend trading. So trend trading is a style that attempts to capture gains through the analysis of an asset's momentum in a particular direction. When the price is moving in one direction, such as up or down, it's called a trend. Trend traders enter into a long position when security is trending up. An uptrend is characterized by higher highs and higher lows, right? Likewise, trend traders may opt to enter a short position, which we can't do in TSP. It means we go to the G fund rather than going short when an asset is trending lower, right? When you have lower highs and lower lows. Okay. Trend trading strategies assume that a security will continue to move in the same direction as it's currently trending. Such strategies often contain a take profit or stop loss provision in order to lock in a profit or avoid big losses if a trend reversal occurs. Trend trading is used by short, intermediate, and long-term traders. So that's what we were talking about kind of earlier. If you are looking at daily charts, which is what we do for our subscribers, we're looking at daily charts because we're trying to avoid we're trying to get out to avoid losses, and we're trying to get in as soon as cup and handle, for example. We want to be able to get in as soon as it breaks above that level so that we can have the least amount of risk.
Right, and it's going to, in our case, we're looking for a confirmation that the trend has changed, which is, by definition going to mean we're going to have to wait till the trend has changed, which to a lot of people that watch us kind of from afar go, you guys knew to get in here. Why didn't you? Because you don't know until after it's happened.
Right.
Like, we're going to wait for the confirmation.
Right.
We're not going to guess.
Right.
Yeah.
And
that means you're going to accept a little bit of time where you're not going to get those gains. And you're also going to have to accept a little bit of time where you're going to get a little bit of loss potentially.
Right. Let me just do this. Is there anything that I really want to show on this? No. Let's just stay on that and go to the bonus chart because it's what we were talking about, and it's pretty relevant. So
I love how you skip your own slides.
Yeah,
that wasn't important.
Well, you get the idea. Everybody understands that the trend trading is the trend, and I can talk about it here on this kind of easier. So here's the S&P 500 daily chart, right? Here's the top in 2022. Okay. From a big perspective, this is obviously a trend, and this is a trend. Okay, that's from the highest level of this chart. There are two trends. One's down and one's up. Within that, this was a trend. This was a trend, right? This was a trend.
And in between trends, we would call those kind of consolidations, right?
Consolidation or a correction to that primary trend.
Right.
So you have to understand what time frame you're looking at. And this is why the day trading thing, again, doesn't work, because you have to have an established trend to as a reference point to trade into or against.
Right. And in that, so draw those lines again with the small trends.
Yeah. So, I mean, that was a trend.
And so what I'm getting at is like those trends there in between those would be very difficult to trade, right? Other than in or out.
Yes.
Now, in between there is when we're normally kind of sitting on the sidelines because it's too hard to play that piece.
Right.
In the TSP, it's
Yes,
too volatile,
right.
or it's
we don't have enough time.
It's indecisive, and the time frame is short. But we're looking at those kind of larger trends,
right? And we, I mean, you say it all the time. You have to expand out and expand in, and so if you're looking at
contract in,
yeah,
it's hard to expand in. Well, I've done that.
So here's the top, right? We came down, we put in a low, came back up. Put in a lower high, right? Once we got back down here and we put in a lower low, we have a confirmed trend.
Yeah, but it wasn't confirmed until there,
right.
Which is halfway down the trend.
Right. And that's the thing. You have to know the game that you're in, right?
Yeah, you could do it earlier and you'd be guessing. That's called gambling or high level speculation.
You can do it. I mean, within so this is a daily chart, right? So if you looked at a 15-minute chart of this, you could anticipate that this bottom was likely to be a bottom, and then when it turned, it's just a matter of bringing the time frames in and bringing the time frames out.
The problem is we can't trade it that fast.
We can't do it.
So if you could trade it that much, then great. This is that's why I love applying your methodology to an IRA, right? It's because the gloves come off and I don't have to worry about 2 days, 2 trades a month and the noon rule, and I'm able to really maximize those without doing much more work. Right? Because the methodology still works and I don't have to worry about those restrictions because the restrictions are what kills us. If they took those gloves off,
Yeah, I know. If they did, it would be great, but they're not. All right, so the trend down, up. You have a bottom. We put an A bottom, and you know that up here where if you drew the trend lines, right? If it's a downtrend, you're connecting the highs, and so the trend changed right there, right? Or at least that was your first indication that the trend was changing, and you have a confirmed bottom right there. The next part of that is the market keeps going up, puts in a top, it rolls over, and so you can say, okay, I have a lower high, right? So the market rolls over and gets below this low. So now we have this trend is in place, and it happened to go until June, right? So this long trend was in place until June. So
that was your absolute line in the sand, is that low right there. Like, you know, if it passed that low.
Which one?
Go ahead and guess.
This one?
No, up top.
This one?
The higher one. Yeah. Once you went past that low,
Yeah,
you knew.
Right.
You knew there was an absolute trend change, right?
Yes.
And so you don't know for sure before that. You might assume, and you can take a lot higher level of risk.
Right. But
I would argue that the risk, particularly in the TSP and a retirement account in general, the risk is much lower if I get out. You know, I'm safe. So my account balance isn't going down, you know, back to that chart. So if we say to ourselves, you know, generally speaking, we wouldn't have completely confirmed that trend change until we got down below that low that Jerry marked there. But what I'm trying to point out is, let's just say you're massively risk averse, right? And you see that it starts to come down that much. I don't think there's any harm in pulling out to the G fund and seeing, you know, if it goes back up again, we can make some more decisions. But once you see that trend change, and then it's even getting closer to that bottom, why take all that, you know,
right.
the downtrend when I got the safety of the G?
Right.
And a lot of times you know, it depends on what time of the month it is and how many moves I've got left and that kind of thing.
Yeah.
But my point here is that, like, particularly on the downside, we're going to tend to want to not take those losses. And that's why I think in this methodology, and you've said this before, like, this works arguably way better at protecting against downtrend, right? Now, getting back in is tougher because you really want to confirm that trend change, really do, as opposed to the downtrend, because you're stuck. If you're back in, you know, too early, then the only place to go is back out. Right. And then I can't go back in because I only got 2 moves. Right. And so I'm only pointing that out because, like, people will see us make these decisions, and that's something that you have to remember is, you know, if we get out and we're protecting against this long downturn trend, that's way different than jumping in too early. Yeah. Right? Jumping out early is not as dangerous as jumping in too early. For us, because our account balance, rule number 1, don't lose money. Right. So if I want my account balance to at least stay the same or grow, I would prefer to jump out early than to jump in early.
Right. I mean, that's our bias for sure, especially in a bear market, right? And when the next bull market comes around, and it will.
It's a different animal.
Then we're going to flip it.
Literally a different animal.
Yeah. It's a bull. It's not a bear. Yeah, literally. But we're
dad joke.
Dad joke. Yeah. We're gonna flip the bias once you're in a confirmed bull market. The bias becomes buy the dip. So we want to, you know, we won't be getting out as quick. We'll be quicker to get back in, but we're not there right now. So I just wanted to point out one other thing about sort of swing trading and TSP. So one of the things that people talk about is as long as I buy back into the stock funds at a cheaper price than where I got out, I'm making money. And essentially, yes, that's what swing trading is. You want to you buy it at a certain price. It goes higher and you sell it and you capture those gains. That's swing trading. In a bear market, if price goes down, say it comes down to here, so that's a pretty big loss off the top, right? And everybody was saying, hey, you know, it's at this trend line maybe or whatever. The market's come down quite a bit. I'm going to buy it because when the market comes back up, I will lock in I'll have gains, right? The problem is that the market kept going down. And so at what point are you going to say, okay, it might take a long time for me to lock in those gains. Now, relative to the high, yeah, if you buy the stock funds here, at some point, someday, it's going to be back above that high, and you will have gotten those gains. But you might be waiting a really long time. And unfortunately, it happens all the way along in a bear market, unless you can look at something like this, and even kind of what we just did here, this.
Yeah.
You need to have some kind of consolidation. This was a pretty good one, right? We had this triangle at a bottom, right? So we had a 1, 2, 3, 4, 5, an Elliott wave pattern. We had a triangle consolidation at the bottom, and we had a big breakout. So if you're a swing trader, that's a time that you want to buy the stock funds, and whatever your exit strategy is going to be. I mean, in this case, it was pretty easy because you connect these 2 points and extend that line and say, okay, as price comes and approaches that downtrend line, I'm going to sell it. That was a great swing trade right there.
Yep.
So I know it's at this point it's probably getting kind of complicated, but that's the idea. So either you're swing trading, you're trying to capture these gains, because all we can do in TSP is long. You can't short anything. That's an example of swing trading. Trend trading, we had a bottom here in October. Market comes up, comes down. We have a higher low. Okay. Market comes back up. We have a higher high. This is a confirmed uptrend. There's no doubt about it. We are in a confirmed uptrend. A lot of people, well, I don't know about a lot of people, but right now the market, I think the NASDAQ, one of the indexes is right at 20% above the October low. And so there are people on Bloomberg saying, well, we're in a new bull market because the market's up 20%. When it's down 20%, everybody knows that's a bear market. It's ridiculous. But that's the definition, according to some of these yahoos, that a bear market is when the market's down 20% from its former high. And so the reverse is true, when it's up 20% from a low. I mean, I don't know why anybody would care about the percentage gain or loss, but the trend, higher highs, higher lows, the trend is up.
And what'll be interesting to see is as we go forward so look at this listener viewer, look at this chart for a second and think about that end piece that Jerry was just kind of scribbling on right there. Now, if you were to back out, right, let's say we get another year or two onto that chart and we back out, that will probably end up looking like a little correction.
Yes.
And there's going to be either a big bear market or another bull market. But right now, because if you look at that, it's really just going sideways. Yep. But technically, it's an uptrend. Right?
Yeah, it's just you just described exactly the time frame.
And that's why I'm pointing that out. It's because we're always zoom in, zoom out. Yep. Because if you don't, you lose perspective. Yep. And perspective is, if you zoom in on that chart right there, you're going to have a difference, especially if you zoom in enough to just take out the whole left side, right? If you just draw a line there, boom. If that's all you're looking at, your perspective is going to be different. Yep. And so that's really the only reason I wanted to point it out is always reminding people, because this is an educational podcast. At the end of the day, we're giving you education and analysis.
Absolutely.
That's literally our job now. And so we hope that the takeaway from this is that you guys, over time, will pick up some of these fundamentals, right? You're not going to learn how to do technical analysis through this show. No. Right?
You have to practice.
You have to practice, and you've got to go out there and study the fundamentals. And there's so much free material out there. You don't need to take courses or do whatever. It's so much free stuff. Stockcharts.com and our buddy JC Peretz. There's a bunch of places you can go that teach you the fundamentals of price, volume, all those things, right? Trends. And once you understand that stuff, then you start to kind of look at some of these other kind of indicators and methodologies that people do to kind of give you a bigger perspective. But you can just take those basic fundamental technical analysis things, price, trends, trend lines, generally speaking, and moving averages, right? And do exponentially well.
Definitely.
over the course of 30 years.
It doesn't have to be complicated.
Doesn't have to be all this stuff that we're always talking about, but we talk about them because there's also people watching who have gotten past that point, right? And so we want to speak to the general audience, but I always try to kind of bring it back to that, so that if you're just first time you're watching the show and you're like, I don't know what the hell these guys are talking about, right? Yeah. But I think my viewpoint is that Jerry puts it in a way that's very, that you can absorb it over time. So just keep watching.
So last thing about this chart, this August high at 4,300 is what everybody in technical analysis land is looking at. We have to get past the February high at 4,200, but this 4,300 number is what everybody's looking at. And so,
why that number?
Because it changes the longer term pattern.
That was when it changed, because we had a lower low after that.
Well, if you do the Elliott wave count, a close above this high means a lot of different things in terms of the count, and so
it's just an important.
It's an important number, yeah. And so there's going to be a lot of resistance there. So even if we do get above it, I mean, let's say we ran all the way up to it, there will be some kind of correction there, and it doesn't necessarily matter, because as long as we stay above this low, the uptrend is still in place.
Can you draw a line across the top from that point? Because it's hard. I think there are lines in there, but it's hard to see. Yeah. So if you were to do that, if you guys are doing your own charts, right? If you were to do that on your chart, just draw that line, right, and leave it on there while you're doing other things. That gives you a great reference point, right? I think simple things like that you can do on a chart to go, okay, because you could get lost as you're doing all this crazy stuff. Sure. But a simple line like that, when a guy like Jerry says, hey, and you won't just hear, if you watch Bloomberg or anywhere, they're also talking about that line. Oh, yeah. So if you take a line like that and you use that as a reference point, that keeps you in perspective all the time, I think. You know, that's one of the things that I've learned as I've kind of trying to piece these things together, is to, because I tend to try to go for like the simplest version of anything. Mm-hmm. It's very unlikely that I'm ever going to learn Elliott wave well enough to do it myself.
Apply it. Yeah,
right.
Sure.
I would much rather let you do it.
Yeah, I would. If I was you.
I sit in the same room. Why would I? But those kind of things, the line, knowing that that's a significant line, helps you make some decisions, even if you don't know how to do the rest of the stuff.
Right. So that line. So we have to get above 4,200 first, which was the February high, but the August high that everybody's looking at, right? So I don't have a chart for this. We'll look at it on the weekly charts, but RSI, right, it's the relative strength indicator. I think it's the most valuable of all those indicators that we use. And as price starts to approach that 4,300 level, if RSI starts trailing off as price continues higher into that 4,300 level, that is about the clearest sign that the market's getting ready to roll over. It's
because it is what it says it is. It's relative strength.
Yes.
Right. So it's telling you how strong this momentum is, this pull.
Yep.
And so all of a sudden you see it hitting this massive line in the sand, and the RSI is already a little bit of a leading indicator, right?
Yeah.
And it's going like this. That should be a ding, 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 ding.
Yeah.
If anything, you don't make a decision off that, but you're ready to make a decision, right?
So in this case, if you had gotten in, like, let's say this week, so we got back into the stock funds this week. I'm going to be looking at those RSI particularly, but some other technical indicators as price keeps going higher, and I'm very likely to get out of the stock funds based on these indicators starting to roll over at that price level. I'm probably not going to wait for price to come back down and get below give us what we call a sell trigger, right? I'm probably not going to wait for that this time, because if it rolls over this time, it's probably going much lower, and I want to lock in some of those gains. I don't want to let them, So that's an example of swing trading as opposed to trend trading. Because if I was trend trading this, I wouldn't get out until we got till a lower low, which would be a change in the trend. Mm-hmm. So
ours is a little bit of a hybrid.
It's a hybrid, yeah, for sure. All right, that was pretty good. Hopefully, people got some things out of that. All right, TSP fund charts. So we're looking at a weekly chart, right? We were talking about weekly charts at the beginning, and the last chart was daily. But here's a weekly chart. And one of the ways to tell the trend for sure is that 20-week moving average line. So as long as that 20-week moving average line is moving up, the trend is up, right? It's one way to tell the trend. Trend is up. When it starts to curve, I mean, it's 20 weeks. It doesn't move. It doesn't move up and down really quickly. So any kind of curving is significant. And when it's trending down, that blue line is trending down, the market's going lower, right? So stock price is above the blue line's moving higher, price is moving higher, everything's great. Once the 20-day starts rolling over, it becomes resistance, and price can't get above it, and so the line is trending down, trend is down, stock prices are going lower. And, not coincidentally, right now, we're flat. Price is oscillating along that 20-week moving average line. So if you're a swing trader and you're looking at this, you might connect the tops and the bottoms and say, okay, when it breaks out of that channel, that's the best time. So if price gets up here somewhere, it's broken out of this consolidation channel, it gets up here, it's likely to keep going higher. If it breaks below it, it's likely to keep going lower.
Goes higher than that high just behind it, right?
That's this August high.
Yeah, exactly.
I mean, it's a big deal.
Yep.
Right? And it's going to be, supported and confirmed by relative strength and MACD. So you got a breakout through that 20-week moving average line here. RSI crosses above 50, and MACD crosses positive. So as long as MACD is positive, we're good. MACD crosses negative. Price gets below that 20-week moving average line. RSI goes below 0, right? Below 50. It's not 100% because you get times like this where you have a whole bunch of churn and the indicators flatten out and you don't know which way to go. That's fine. You don't have to do anything.
Yeah, and that's where I think it goes back to that day trader mentality.
Yeah.
Is in that little section that Jerry was talking about where you really can't play it. That whole channel really. Even before that, just before that, that is the area in which it is very difficult to trade in the TSP.
Yep.
You might get lucky, but it's very difficult to trade. And that is when we hear the chatter the most from people of like, oh, I missed yesterday's gains and I missed, and this is a weekly chart, right? This is not a daily chart. And so you really got to stop doing that. You're killing yourself. If that's your way of watching the market and you're doing it for the TSP, you're doing yourself a disservice.
Yep.
You really are, because you can't do any better. You can't day trade it.
You can't.
We say that all the time, and I think this show is probably the best example of why you can't, and the best explanation, right?
Yeah.
And we've really dug into it, and I hope people, I know you got to do a few more charts, but I don't want to forget to say this. I hope people rewind this. If you are one of those people and you'll let your ego go away enough to do some self-reflection, if that's the way you're playing your game, and if you listen to us and you say to yourself, okay, well, what do I do to change it? Rewind this, watch the swing trader and the trend trader stuff, and get yourself a better plan, right? Because that's what we really preach is have a plan.
Have a plan.
If you don't have a plan at all, I'm not even sure you should even be in the TSP, other than maybe
be in the L fund.
Yeah, might as well. Yeah, that is
Yeah.
probably your best option. I would not recommend just putting in the stock funds and letting it roll, because you're not even anyway. The point is have a plan. And so if you're willing to take the time to make your plan can be any of these methodologies that we've talked about. We would argue that the one that acts like a day trader is not going to work. So we don't recommend
think that
one.
way. Yeah.
Right. But the problem is I see a lot of people aren't executing that way, but they think that way. Right.
Yeah. So here's an example of that, right? You got a 2.5% move in the C fund this week, right? If you weren't in the stock funds, you're like, I could have had a 2.5% move. Why? Well, that's terrible. I missed this big gain. But if you just step back and go, wait a minute, we've been in this sideways channel since November. And until it breaks out of that channel, it's going sideways. And since the channel is so narrow that you can't trade it in TSP, then it doesn't matter that the market was up 2.5% this week. It doesn't mean anything. You can't use it. Okay. So having said that, you get the channel. On the definitely the positive side, you have the low from October. You get the low here, and this low is still a little bit higher, and we close the week above that 20-week moving average line. So price cannot go higher when it's below the 20-week moving average line. It has to be above it, and this week we close above it. It increases the odds that price keeps moving higher, but that's all it does. It increases those odds. So for me, if I'm looking at it and I'm drawing the channel, that's great. Nothing matters until we get outside of that channel. Either way, right? Okay. S fund, pretty similar actually. You got that bottom there at 1500, and you got pretty much a double top here. So you pretty much got, the same kind of channel. It's wider. So in the S fund, it's a little more annoying because, and you could try, if you want to try to play this distance, you could do it. It would be swing trading. Nothing wrong with that. But it's just very hard to execute in TSP. It's just, there's not enough distance. One way you could do it is if price came down to this 1500 again, you could get into the S fund, right? And then if it closed, say it closed down there on a weekly basis at 1450, you'd know that it broke that channel to the downside. So if you buy it at 1500 and you say, okay, I'm willing to lose down to 1450, then you get out, right? That's one way to do it. So it completely personal preference. iFund had a much better rally off that October low than the C or the iPhones. And on a weekly...
C or the S.
C or the S, yeah, sorry. This is huge. You don't see that, so the S fund is oscillating along that 20-week. C fund, same thing, oscillating along that 20-week. That chart of the I fund is much different, and that breakout is a monster. You get support at 50 on RSI, and MACD is rolling back positive. That's a huge breakout on the I fund, and we've been talking about it for a while. The I fund is so not so much undervalued, but the relative performance of the I fund to the C fund over the last 15 years is bound to change. Mm-hmm. And we've done some charts in the past.
Particularly with all the macroeconomic things that are going on.
Yeah.
And somewhere during this podcast, I know that we mentioned that we're back in the stock funds. And if you're looking at these charts and you're wondering why, the only way you're going to know is if you're a member, because we take a deeper dive into the analysis. And particularly when the alert came out, Jerry always does an alert analysis kind of post, a video and write up, and it tells you what happened along there that caused us to get back in.
Yep. And a lot of people don't like the iFund, but there's a lot more potential based on what's going on in the world for the iFund to do better relative to the C and the S going forward. And it's obviously kind of playing out that way. You can see it clearly in the chart.
Why would you like or dislike a fund? I don't understand that.
I don't either. I see it all the time, though. I don't like the F fund. I don't like the I fund.
I get it when people say that.
I don't like the fund that goes down.
Right. I see it. I understand this when people are talking about stocks. I get that, because if you're talking about Apple, I don't like Apple. I understand that you might not like a company, its practices, its management, its philosophies, all those things. I got it. These funds are not companies, right? They're massive indexes. And how you can not like basically a technical thing, like, I just don't get it. I mean, I know, and some people say it tongue in cheek, like, I just don't like.
Well, because they always lose money in those funds.
Well, because you're in at the wrong time.
Right.
That's the whole point. Like, being there in the right time, you'll love that.
Yeah.
I can't tell you how many times before we met or before, I really started kind of getting in this stuff with you, that people would tell me, like, forget about the G fund. Of course, they would always say, like, why would you be in the G fund? And they're like, the F. There's absolutely no reason to be in the F until you go back and look at a few years and you go, particularly when we were in it, and you go, oh, that's the only way I would have made money.
Yep.
And who cares whether I like it or not? Well, what about a bond fund do I not like?
Right. Right.
Because it doesn't, The point is
if you liked the C fund or the S fund last year, I don't know what to tell you.
Right. Well, this just goes back to the whole thing of treating all this stuff with emotional attachment, right? And if you like or dislike something, and you really mean that, and you're not just saying it tongue in cheek, if you're saying that, that means you're emotionally connected to this, and you've got to find a way to get out of that.
Yeah, for sure.
Speaking of fun,
this is a big deal. Just saying.
Ding, ding, ding.
Yeah. F fund. I talk about emotion.
I want to like it.
I want to like it. I do. I really, really want to like it. This is from this top here after COVID to this low. There hasn't been a collapse in bonds like that since back to like 1750 or something insane like that.
Right.
It is the biggest collapse in bonds. So if you are of the idea that the fund, usually it's in terms of the stock funds, right? I'm buying the C fund now because it's really cheap. So if this is your mentality, the F fund is the cheapest it's been in 300 years.
It's the cheapest it's ever going to be probably in the next 100 years.
Well, perhaps but that for me, that's the thing. Like, okay, I got it. It's way undervalued right now. Is it going to get more undervalued?
If you believe that, and it would have to go lower than that.
Yes.
Right. And of course, what we're looking for, correct me if I'm wrong, Jerry, I know you will. Why aren't we in the F fund? Well, generally what we want the F and the C to do is to be going in the different directions.
Right.
Because then that's back to normal.
Right.
And so that's how you generally play that game with stocks versus bonds, is when they're going the same direction, why would you be in bonds? When we're talking about the TSP,
Yep.
when we're talking about TSP, if they're going the same direction, you don't want to be in both, or you would choose stocks over bonds. And once they diverge, that's when the money maker. That's when the opportunity is there.
Yes.
Because of the C fund, particularly, and the S will follow. Right. If those are going down, and bonds do what they normally do, which is go up. Well, now we have an opportunity to make some gains, even though the market's going down. Right now, for the past however many months, they haven't been doing that. They've been traveling together, which is like, it's not normal.
No, and it's what was really bad last year, 2022, the 60-40 portfolio that, the
killed you.
Financial industry pushes.
Because they both were going down.
Because they're both going down, yeah.
Yeah. And there's no way to tap dance your way through that. That means you weren't really managing that money. If you were that money manager and you were watching the market and the bond market, right, and you were seeing both go down, and your client's got 60-40, you can't explain that away.
No, that's why even with a 20% decline isn't that big a deal in the big scheme of things. Right. But when both stocks and bonds go down that much, that's a very big deal.
Yeah, your 60-40 is going down, 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 down. Yeah. Not one is going down and the other one's going up a little bit, and it kind of hedges that out. And that all works when everything's working normal. If you guys haven't noticed, nothing's normal in the past few years, even before COVID. But, it's not about COVID. It's about what happened while that happened, right?
Yeah.
It impacted financial markets. And other things have also, and when you combine all those things together, you've got what we've got going on right now, which is, I've been watching lately, a lot of financial analysts that are just so on their heels because they didn't prepare for this. They're not really understanding what, and so they don't really know what to do.
Yeah.
And so, get educated.
We're putting out today, right? We're going we're going to post an F fund like special report for.
So this will be out on Sunday. This podcast will be on Sunday.
Podcast was on Sunday.
You'll see it on Friday.
Subscribers to the site will see this F fund F fund special report kind of thing.
Yeah, it's like a market update, but just on the F fund.
Just on the F fund.
And it's worth watching, folks. If you're not members, you're not going to see it. But if you're members, you'll see it, and it's worth watching because it really helps you understand the bond market.
Yeah, this the one of the charts I put up in there is the long term chart of 10-year yields, which peaked in 1982 and have been coming down and put in a low at 0.5% in 2020, and that was the yield works inverse to price. So the low in yield is the high in price, and that was right there, and then it collapsed. So it's going to be it's a good it's a good report. It's worth taking a look at. But let me just go back to this one real quick here, because it's kind of real time. So yes, the F fund is way historically oversold. 1, 2, 3, 4, 5. You could count that as L8 wave. So if this is a 5, then we should be 1, A, B, C, for 2, and we keep on going, and the F fund goes higher. That's one way to look at it. And if we can get outside of this channel up here somewhere, then very likely that's what happens. The other way to look at it is 1, 2, 3, 4, 5 for a 3. This is our 4, and then a 5. And I tend to think that, I think that is where we go. But I don't really care what I think. if we break above this channel, then we're going higher, and I'm back in the F fund. But so can bonds get even more oversold, and will it be a better time to get into them? Possibly.
Because generally, what we would think that would mean, right? And here we're crystal balling a little bit, so just bear with us. But if the bond fund goes down,
yep.
The general thinking is that that's because the stock funds are back in a bull market, right? So they're going up.
In normal times, yes. Yep.
If that happens, then all gets better, all gets right in the world again. And so the stock funds are going up and everybody's happy. Nobody's paying attention to the bond fund now because it's tanking, but that's because it's back to normal. And then, we could see,
or they keep going, or they keep going in the same direction,
or they go down
together. Stocks and bonds all go down together,
and then everybody's shaking their head, going, right. That's kind of what I'm getting at. Is like that's what the expectation would be if you're just thinking like you've always thought. Oh well, if Jerry says there's a chance that this is going to fall off, well that's okay because the stock funds will be going crazy. Well, what if they don't? And we've already seen them traveling together. And so if we're going into a bigger bear market, which a lot of people are saying we're headed there. And so none of us know, right? We're just going to respond to what it does. That's definitely a takeaway.
I think
we got a plan A, a plan B, plan C.
Ordinarily, stocks and bonds generally work against each other, right? Because if money flows back and forth, and so when money is flowing into bonds, it's flowing out of stocks, so stock prices are coming down, bond prices are going up.
Makes sense.
And the reverse. It makes sense. Since the top in 22, stocks and bonds have been going up and down together. The theory is that the Fed raises rates, something breaks, people flee to the safety of treasuries, and so treasury bonds, which make up about 40% of the F fund, they go up, and stocks go down. That's that divergence that we're talking about that we're looking for. That's one possibility. The other possibility is it just continues the way it's been going, where stocks and bonds go down, up and down together. The third possibility, which is seemingly impossible, is that bonds go down from here because they're at historic lows, right? Bonds go down and stocks go up. That's seemingly at this point in the game an impossibility, which means it's probably what's going to happen. But those are basically the only three.
Last year or two, yeah.
It's crazy. Yeah. All right.
Questions.
That was a good one.
Yeah, man. If you don't have a lot of questions after this one, man, you're just not watching. But if you do have questions, you can put them in the comment section wherever you found this video. If there is not a comment section, you can shoot us an email at support@growmytsp.com. The support team will happily pass it on to us because they're not going to be able to answer that question probably. They're more normally there for customer customer support. Yep. But these kind of questions, they push them to us. But if you don't find a comment section, fire away. Hope you guys had a great week and hope you have a good week coming up. I'm looking forward to it because it's going to be Masters weekend next weekend.
Masters weekend, and 70 degrees on Monday, sunny.
I like watching that golf tournament.
Yeah.
All right, guys, have a great week. We will see you later.